Hi friends, welcome to Surl Trader. Today I'm going to share with you one strategy that I use to sell options on index. So this is basically a strategy called as the put credit spread. So typically what we would do in this, any index like IWM or sorry about that. So any of the index like IWM, Nasdaq, or SPY will generally operate in a range usually, and sometimes that range is broken as well. But generally they operate in a range. So using a volatility index, volatility index like VIX, VIX is the standard index that is used for S&P 500. It typically tells you what is the level of volatility that the market participants are kind of expecting. Say VIX is 19, 15. So what it typically means is that there is a expected volatility of 15%, 15.5% up minus. So market participants are expecting the markets will go up by 15, or they may even go down by 15%. And that's the way they are kind of pricing in the volatility and selling the options. So typically, using VIX, we in my system we extrapolate this number to come up with a daily range for S&P 500 or IWM. So using the custom system that we have. So typically, using volatility, we generally get a range and key levels on which the market will operate. This is a very regular system. I just wanted to show you how we calculate it. So suppose the volatility index SPY VIX is currently at 15.54, and S&P 500 futures or SPX has closed at 61146. So typically what we do is we will take the volatility number. This is the custom sheet that we have prepared, and we'll take the volatility, the index number, which is 6114.63. And once we put it based on our algorithm, we get a daily range for the markets. Now this is a daily range. Sorry, I probably put one extra one here. So yeah. So the range for today is 6065 approximately, and the range will be around 6164. So overall, a 100-point range is expected on both sides from the current price. So 6065 and 6164 is the range. Now, based on this range, when the market opens, I have backtested this system on SPX for almost 1700 trading days. There is a very high chance, 70% chance that the markets will close within this range. There are some very high volatile days, like the 28% days in which the ranges are broken. But even when the ranges are broken, almost 50% of times the markets come and close within the range. So there are only, say, around 10 to 12% days on which the range is excessively broken and markets don't come back. So those range days are generally high volatility days like FOMC or some big news comes in. So typically what I do in this system is, because SPX is very big contract, in options, I generally look at SPY. And as soon as the market opens, I will decide what kind of option I need to sell. If I have to, generally, if I am bullish, then I will go and sell the back puts. And if I am bearish, I will generally sell the call spread. So typically what you do in this is, once the market opens, depending on what your bias is, you can go back to the options and you can look at the range. So SPY range, if you're going to do with the SPY, so the SPY number was 609.7. We'll get the range for it. Now the range is 604.75 to 640. So typically as the market will open up, I will go, and once I'm ready to sell, what I will do is I will go and look for 0 DTE options. And the range for today is say around 604. I will look for option of 603 to sell. And to hedge that exposure, I will either buy 602 or 601. So typically I will sell 603. Markets are right now closed. So we are selling this. And once you are selling, it's a risky, it's a cashback put. So you must have cash in your account. And to hedge this exposure, I will buy one down put and make it a credit spread. So in this, we are getting a credit of 11 cents. And if you look at the payoff table, you have a risk of 189 and the max profit of 100 of $11. But typically, as you know, that the markets are not going to cross based on the historical valuation and the backtesting. This trade either you can do with cashback puts or you can just make a credit spread. And I just generally do it for regularly for indexes to get that credit because the edge is on your side. This is 0 DTE option. So as markets go in your direction or remain range bound, you are these options will lose value very fast. And typically most of the days, 70 to 80% of days, they will expire worthless. And just in case you get the delivery, then or the assignment happens, in that scenario you should have cash in your account to hold that position, or you may do the hedging through it. So just in case the assignment comes in, you can hedge it by selling micro futures so that you are not you have unlimited loss there. So this position, this is something, it may look very risky, but yeah, it is risky in the sense that the assignment may happen. And if the assignment may happen, you will have to have cash in your account to hold that position, or you will have to hedge it. But typically, as indexes are mean reverting, I would not mind taking an assignment and typically holding that position, or I will hedge that position using options, or I will hedge that position using futures. So I've been doing this regularly. I do it on IWM, which is the small cap index. It also has 0 DTEs. So similarly, the IWM has the volatility index, which is called as RVX. So I'll put in the RVX numbers and I'll get the daily range. And based on the daily range, either I will sell the calls or I will sell the puts. This doesn't need a lot of monitoring as well, because typically once the range is if you're making a credit spread, or you're making a you're making a credit spread, you are already hedged. So you just have to see towards the end, what is the value you can put. I generally get 50 to 60% depreciation in the sold puts and calls within the next 2 hours. I've seen that. So if you want to get the daily ranges, and other thing is that some traders, what they will do is once they get the range, depending on how they are trading or what their risk profile is, they will sell the put credit spread and they will also sell the call credit spread. Now, how do you do the call credit spread is that, suppose you get the range, that the range is that market will not cross 230 or whatever, 227. You can just go sell one call here and you will buy the other one. So in this, you are getting a 16 cent credit, and this becomes your trade. And so what they will do is they will sell the call credit spread on the upside and they will sell the put credit spread on the downside. So that makes a range. It becomes an iron condor kind of a scenario. So this way, people are I generally use to generate regular cash flows. But you need to ensure that you have enough capital in your account to take the assignments, or if the assignment comes in, you should be able to hold that position or hedge it. So if you have any questions, do let me know. Thank you very much. Bye bye.